Do you remember that one time when there were a bunch of subprime borrowers who borrowed a bunch of money, and then all of those loans were packaged up together, sliced up into tranches, sold off to investors, and then inevitably, when those subprime borrowers began to default on their loans, it triggered a global financial crisis and subsequent recession? Well, would you believe me that that same exact thing might be happening again, except this time not in real estate, but with auto loans? Well, let's go over the data and see if that is truly something that we should be concerned about, and if so, what to do about it. So first, the debt problem. It is no secret that Americans love debt. As of Q3 of 2025, non-housing debt topped $5 trillion. When you add the $13.5 trillion of housing debt in, it means US households altogether hold over $18 trillion worth of debt. If we break down the non-housing debt by type, we can see that auto loans across US households are up to $1.66 trillion. Now, overall, if we take a look at delinquencies, and specifically what we are looking at here is the percentage of auto loans that are 90 days or more delinquent. Auto loans are the green line here, and we can see it's at 5%. And if you look at the history of this green line, that is really not out of the ordinary. It's definitely higher than it was at the beginning of this data collection back in 2004, but it's about the same that it was around 2009 through 2011, and it's been at about the same point since 2019. But the last couple of years has been a trend where this delinquency rate has been increasing, and so far it doesn't look like it's slowing down, which means it might go up to a new record. But again, 5% is really not that big of a deal. But the thing is, this is looking at all auto loans from all borrowers. And that's not where the true problem lies right now. The real problem is showing up in subprime borrowers. And in fact, the percentage of subprime borrowers who are late on their auto loans is over 6.5% right now, which is the highest delinquency rate that we've seen since 1994. Now, it's not just that subprime borrowers themselves are starting to grow in their delinquency rates, although that would be a problem in and of itself. There's a deeper problem going on here, and that's that subprime borrowers as a category is actually growing. In other words, more borrowers are moving into that category of being a subprime borrower. Subprime borrowers account for 14.4% of consumers in the third quarter of 2025, which is up from 13.9% in the same period last year. A large part of this does have to do with the economy overall. Right now, households are being squeezed because prices are still going up. That's what happens when you don't shut down the deficit and you don't shut down the money printer. Prices continue to go up, and it's not going to slow down anytime soon. And that is reflected when you look at the price of new vehicles in the United States. And while you can see that according to the CPI, the cost of new vehicles in the United States has flatlined over the last couple of years, and the cost of used vehicles has slightly declined, again, according to the CPI. We also know that these numbers coming from the Bureau of Labor Statistics are adjusted for quality. You can see that straight from their website when they talk about quality adjustment in the CPI. And we can see that new cars and trucks and used cars and trucks and even vehicle leasing have cost-based adjustments that you can read about on their website. You can see that if there are changes that affect the safety of the car, changes in mechanical or electrical features that affect the operation or efficiency of the car, or things like stronger bumpers, HID headlamps, platinum-tipped spark plugs, or even redesigned seat belts, remote door locks, navigation systems. These are all things that the BLS uses to decrease what the reported cost of the car is, which means even if new cars on average are increasing in price, the BLS will go in and they'll look and they'll say, are there new features being added? And then we will adjust that cost increase lower. And just a heads up, guys, if you are worried about inflation, the AI bubble, or the current state of geopolitics, on November 23rd at 7 p.m. Eastern time, I'm hosting a small event that's going to be live on Zoom. I'm calling it the Traders Wanted event because I'm looking for a small group of 250 people that I can take under my wing for the next next year. I'm going to teach you a strategy that I use in my own account to profit from the commodities space. Now, if you've heard of commodities trading before, don't worry. My strategy requires no margin, no futures, no shorting, no leveraging your account or unlimited loss potential strategies. It just requires an open mind to learn using a special type of trade. It's one that can allow you to amplify your returns while only risking what you put into the trade. In fact, I've used it to take home returns of like 246%, 282%, and 788% in a matter of months. And while those big winners are the exception and they are not the rule, I want to show you everything I have learned on the call. So if you're interested, click on the link in the description below. Attendance is completely free, but spots are limited, so sign up now. Now, certainly some of this is warranted, but if you've gone and shopped for a new car lately, you can see with your eyes the price tags are higher today than they were a couple years ago, than they were 5 years ago, than they were 10 years ago, and certainly a lot higher than they were much before that. And so yes, there has been a quality increase by certain metrics in certain cars, but that doesn't change the fact that those cars cost more and there's no cheap cars. It's not like you can just go and say, I want to opt out of all these features. Those cars just aren't available. Now, don't get me wrong. I am not trying to make excuses for people who are in bad financial situations from their own bad decisions, just deciding to buy brand new cars that they can't afford. Despite circumstances, there's always a choice you can make that will improve your financial situation. And anybody who's in a bad financial spot, who's deciding to throw money down the drain to buy new cars, is making a bad financial decision and making their life harder and worse. So it's not their fault that new cars cost a lot, but it still is people's own responsibility to make good financial decisions, and it's still possible today. But despite all that, it is true, cars are getting more expensive, which means it is becoming harder and harder for people to afford loans for those cars, which is why we are seeing more insane things like 12-year auto loans. More and more people are extending the life of their auto loans to crazy lengths like 144 months. What do you think the price of that Cadillac or that Mercedes or that BMW is going to be in 12 years? The moment you roll it off the lot, it loses at least 10% of its value. 12 years from now, when you finally pay it off, that is if you don't roll that over into the loan of a new car that you exchange it for before 12 years from now, how much do you think it's going to be worth? It's going to be worth a lot less than it is right now, which means there's a good chance in between now and then you're going to be underwater on that loan. And if you are only getting a 144-month loan because you can't afford anything else, you're getting yourself into a very dangerous financial situation. And that's what many borrowers have been doing recently, which is why so many of the worst quality borrowers have gotten themselves into situations at risk of default recently. Now, that by itself would just mean that, hey, we might be in a situation where a lot of people have to sell their cars at a loss, they owe money to the bank, they're losing their cars, and people who have done things the right way would be sitting on the sidelines waiting for a bunch of used cars to come on the market at really good deals. That's typically how the free market would settle things like this. But we don't have capitalism or free markets in the United States, which is why there's so much concern about subprime auto lenders right now. I want to be clear, this is not a potential concern for the future. Subprime lenders are already starting to blow up. Tricolor Holdings and PrimaLend Capital Partners are two examples of subprime lenders that recently collapsed. And this concern means that investors are now demanding roughly 0.5% more yield on this lowest tranche of subprime auto loans compared to even just 2 months ago. This is what the chart looks like for risk premiums on the different tranches of subprime auto loans. You can see recently it has been increasing, signaling investor concerns that defaults may be getting more likely. Other lenders like Automotive Credit Corp have already paused new lending indefinitely. And in a terrifying echo of the past, we can see JP Morgan analyst wrote that subordinated subprime auto ABS tranches are not unbreakable, but the structures are built to withstand a reasonable amount of stress. Maybe a better way to put it is that you think that problems in the subprime market seem likely to be contained. Just in case you didn't get that reference, in 2007, Ben Bernanke stated that the problems in subprime mortgage market seem likely to be contained. We're also also seeing impacts of this potentially show up in the overall stock market, with large companies like Carvana being accused of fraud, specifically in the auto loan and subprime auto loan space. During this entire run-up in Carvana's stock price and in the most recent run-up in Carvana's stock price, insiders have been unloading billions, that is billions of dollars worth of shares, using that money to allegedly fund separate companies to buy bad loans off the books of Carvana. This was detailed in a short report from Hindenburg Research at the beginning of 2025. And as of this moment, I believe the lawsuit is still ongoing, but as you can see, has not really led to any significant decrease in the stock price, which is holding up especially well compared to its peers like CarMax, which has just imploded over the course of the last couple of years. Now, I understand there's a real question on everybody's mind at this point. Is the problem with auto loan backed securities, ABS, similar to mortgage-backed securities in the scope and the extent of infiltration into the overall financial system? In other words, are banks at risk of collapse if these things start defaulting at a greater rate than people were expecting? And the answer to that is almost certainly no. Could we see companies like Carvana or CarMax or other auto loan focused companies collapse as a result of this? Absolutely. We have already started to see that, as I showed you with the collapse of Tricolor and other subprime lenders. But it seems very unlikely that banks like JP Morgan and Wells Fargo and Bank of America, in other words, the broader plumbing to the overall financial system, have the exposure to ABS necessary to pose the same amount of risk that mortgage-backed securities did. Consider that at the peak, US residential housing debt before the financial crisis equaled 9.9 trillion versus the amount of total auto loans right now across US households is only 1.66 trillion. And in the run-up to the financial crisis, nearly 30% of all originated mortgages were subprime. So the total amount of debt, in other words, all of the mortgages, was a much larger pile of debt than we're dealing with right now with auto loans. And also the percentage of that debt that was subprime was a larger percentage than we are dealing right now with auto loans. But let's just say there is contagion. Let's say exposure is more than we think, and large financial institutions are actually at risk here. Well, this is the chart of the Federal Reserve's balance sheet, and in the wake of the financial crisis, they began to buy a bunch of mortgage-backed securities and also US Treasuries. Recently, they have been winding down the size of their balance sheet, and they have announced that will be coming to an end soon. But this is what their balance sheet looks like if you only look at the mortgage-backed securities they hold. And they have announced that they will continue to sell off mortgage-backed securities, and that is in order to fund purchases of more treasury bills. The reason why I'm showing you this is because when the banking system was in trouble, because a big mortgage-backed security problem was blowing up, they bought all the bad loans. Back in 2023, when the banking system was in trouble, this time from treasuries being underwater, not mortgage-backed securities, look what they did. They bought a bunch of treasuries, even though they were in the midst of winding down their balance sheet. In other words, the Federal Reserve has a well-established history and track record of bailing out the banking system by buying bad loans when banks need them to. Yes, they are selling down their mortgage-backed securities right now to make way for more treasury bills. But if banks are in trouble and it has even the smell of a hint of contagion that could spread throughout the financial system, the first thing that's going to happen is the Federal Reserve will start buying auto loan-backed securities, just like before they bought mortgage-backed securities. So for the sake of everybody involved, I do hope that this problem stays small enough that the lenders who lent these bad loans do end up failing, that the borrowers who borrowed these bad loans do end up losing the cars, and those can go to people who are more responsible at better prices. That's how the free market should work. And I really hope it doesn't spiral to the point where it becomes a big enough deal for intervention and for the Fed to step in, because ultimately at the end of the day, what that will do is drive up prices of everything through more money printing, subsidizing failure, and setting us down a path where in the future more and more people cannot afford cars, similar to the housing situation we have today. And I hope for everybody's sake that doesn't happen. And for unfortunately, that's also what it looks like the most likely outcome is here. So there might be some opportunities across the market to profit off of the downside of some of these companies who are overexposed to bad loans. And if some sort of a bailout does occur with a Federal Reserve purchase of auto loan backed securities, well, then that's just more QE, and you know the drill for that as well. And remember, if you're interested in joining me to learn about the areas of the market that I am very bullish on right now and how I am playing that, don't forget to sign up to my Traders Wanted event happening in just a couple of days. So click on that link in the description below, sign up. I will see you there. Thanks so much for watching. Have a great day.